Begin with this question. How do you explain to yourself, because you have to do it, a world in which the S&P 500 started the day 11 points off of its all-time record high, and which is trading at almost 19 times forward earnings, high yield spreads at 370 basis points, but at the same time you have the 10-year Treasury again starting the day at 215, and the yen having rallied 6.5% year to date. These haven trades playing out strongly, yet the risk trades also playing out strongly.
Well, and you mentioned several assets there. You're talking about bonds, you're talking about stocks.
You're talking about the world, the investing world that you have to confront every day.
Yes, and if there's a commonality to it or a common factor, I would say it's the expansion of credit and the credit that's being generated by central banks. You know, the Fed has been out of it in terms of building its balance sheet, but the BOJ and the ECB have been moving along at the same pace at $60 billion a month, a total of 120 and $1 trillion a year. And so money is being pumped out into the system, and money that is yielding less than nothing in many cases seeks a haven, not only in bonds that are under yielding, but in stocks that are overpriced.
So is that to say this addition, if you will, of liquidity will help to continue supporting risk asset prices so long as the BOJ and the BOE, more importantly, the ECB are quantitative easing?
Well, I think so. That's been the game plan, and it worked wonderfully, and it has worked.
Sure did.
Not criticizing, you know, basically
worked wonderfully for investors.
Yeah, the global economy as well. It was pulled out of the Great Recession, which could have turned into a Great Depression, and so, you know, not criticizing the policy, but it has to continue, in my opinion, in order for credit spreads to be tight, in order for yields to remain low, and in order for stocks to have such high PEs, because the fundamental basis for it is the central bank policy that keeps creating additional credit.
So it continues until the QE punch bowl gets pulled away.
I think so.
Okay.
And the question becomes how quickly the punch bowl is taken away, and or whether it's a policy move or something precipitated by the private sector in revolt against low interest rates. They move somewhere else. You know, the old money in a mattress. An individual can do that. In Germany, can put their euros in a mattress, but an institution can't. But gradually, at the margin, the system itself may degenerate simply because the returns are unattractive, and they prefer to put it in a mattress.
They may not be the same bond vigilantes of old, but they'll be.
Oh, for sure. Yeah, the bond vigilantes of old are basically index-oriented, and so they must maintain certain high levels of duration even when yields are unattractive. Individuals, and they're a smaller part at the margin, but individuals can play a different game and simply avoid themselves of hearts. So
you sound a little bit hopeful. Do you think this buyer's strike, if you will, is going to actually happen?
Well, slowly, and that's the problem for an investor, because as it happens slowly, and if you void your hand, so to speak, of a certain suit, or if you void your hand of risk assets, then you accept much lower returns, and there are those investors, even individuals, that think they require higher returns, and so voiding is perhaps reasonable and commonsensical, but not necessarily practical in this type of environment.
Well, you're practicing some of that a little bit yourself, are you not? You told me earlier this morning that your level of risk aversion has been higher only once before, in the lead up to the Lehman Brothers bankruptcy.
Right.
So I presume that your positioning, if you will, reflects some of that. At the same time, though, timing is difficult to predict. How do you balance the caution with the need to earn some return? What do you own?
Well, you own, obviously, what you think are the most attractive and least overvalued assets. I would suggest, as we do, that there are attractions in closed-end funds that sell at discounts, 5 to 10% net asset value discounts that are levered to some extent off of that cheap leverage and yield 5, 6% in the muni market and 8, 9, 10% in the corporate market. So you go there and you basically tell your investors that it's a changed world, that returns are going to be lower, and that if you want to sleep at night and to accept the market as it is, that low volatility requires low return.
What about Treasuries? What about cash?
Well, I think Treasuries are the most attractive of the developed market bonds, and in comparison to the 10-year Bund, for instance, at 25 basis points. I'll add that quickly, 190 basis points, and relative to a 10-year JGB, that one's easy because they yield 10, that's 205 basis points. And so, they're more attractive on a yield basis, but still, I would suggest that they're overvalued price-wise and under-yielding, and investors should be cautious in terms of how much they want to own relative to cash.
Do you have a cash position?
Oh, I have a large cash position.
How large?
Oh, I put it in a durational context. So the Unconstrained fund, which has a 0 duration benchmark, has a -1 to 2 year duration, which means that it's accepting a cash-like and in some cases a lower than cash-like return by its positions.
Bill, when we last spoke, it was at the Milken Global Conference in Los Angeles.
Yes.
Last month.
Right.
You told me that you'd give yourself an A- for performance in the 1.5 years, excuse me, it's been since running the Janus Unconstrained. 2.5. 2.5?
2.5.
I'm losing track of time. 2.5 years.
September of 14.
And a C+ for fundraising. So what I want to know is, how do you turn the C+ into A- or better?
Well, you continue to promote, to talk to viewers on Bloomberg, to express your philosophy and concern, and to let them know that you're still active and in the game, I suppose.
Do you need to travel more?
Probably. That's something that I haven't done, but I tend to generate my communication through writing investment outlooks and through TV and so on. But yeah, traveling would help.
And Janus has just completed its merger with Henderson.
Oh, yes.
Will that help?
I think so. I think Henderson can join in terms of asset growth, and the asset growth of the Unconstrained fund, while not PIMCO-like in terms of numbers, it's positive every day. It's a 2 or 3 million every day, and it's a smaller world. It's a small world after all, like in Disneyland. But it's an enjoyable one, and as long as investors are increasingly putting money in, I'm a happy camper.
Bill, a question to you about the Fed. There are no puffs of white smoke yet from the White House, but it does look like we know who the next 2 nominees to the Fed board are going to be, Marvin Goodfriend and Randall Quarles. How do you think Fed policy will be different if they were to be nominated, approved, and sit on the Fed board?
Well, we'll have to. It's easy. We'll have to see. But I think Janet Yellen, despite her demeanor, is a very tough-minded chairwoman, and not necessarily any tougher than Bernanke. Maybe a little less tough than Volcker, but she's tough and she dominates. And so I think she has a team. She listens, but I think she guides and directs.
Do you think they'll be inclined to allow leverage to rebuild in the financial system, something you've warned against?
I hope not. And that comes from the regulatory side of the Fed, one in which they failed, pre-Lehman. To criticize Alan Greenspan, he was never a regulator. He was always an interest rate director. And so, regulation has become more and more important. The trend seems to be shifting the other way, but, I think ultimately credit and credit extension is at risk, or risks another recession, if only because if the price of credit rises in a levered world, then the cover or the ability to service becomes at risk, and companies start to default, and positions start to be liquidated, and markets move the way they shouldn't move.
Something